Hey, everybody. Welcome back to the show. Like I said in the introduction, I am sitting down with Austin Mitchell, the CEO and co founder of Synota. Austin, welcome to the show.
Thanks for having me, Ben. It's great to be here.
Yeah, well, and it was a lot of fun. We were talking about this before we hit record. We got a chance to bump into you maybe 10 different times at the Texas Blockchain Council event. I have to start by asking, how was that event for you guys?
It was an amazing event. So number one, second year going to the event. Last year I went, just down as myself as a company. We had just raised capital, so I was really, down there getting to meet people, networking, etc. And what's really incredible is that this year we actually got our first booth as a company. And
Yeah.
so, a bigger part of the team went down, including my two co-founders, Lisa and Alan. And so not only did we, have a booth, but, one of the cool things, when you're building a company, and this is my first time, being an entrepreneur like this, one of the cool things is, the experiences that you have along the way that sort of help you sort of internalize that you're doing the right things. And
Hmm.
so for us, being in a position where it's we're not sort of, our sales mode can change, where we're really just introducing future potential customers to existing customers, and kind of letting those interactions sort of do the hard work for us of, hey, we're using the product, we're liking it. And so that was really neat to see how, in this period of time, our own growth as a company can really be measured through that conference, and the interactions that were happening, really naturally between the people that
Yeah.
we're working with, and hoping to work with in the future. So we
Oh,
loved it.
that. It's
And shout out, of
phenomenal.
course, yeah, the shout out to the Texas Blockchain Council, and everybody there, because they do an amazing event. I mean, the headliners that they have there, the perspectives that get shared, there's really nothing like it in the space. So we'll definitely be, going back in future years, because it's very high signal.
Absolutely. I mean, hats off to Lee Bratcher and that team. I mean, of the conferences I went to this year, there was not one that I went to where there were presidential candidates just roaming around giving
Hmm.
keynote speeches. So, very high signal, very cool to see that. And I mean, there's even just a mix of new blood coming in to, from the mining industry perspective too, which that is so needed because usually these conferences, it's like the same 100 people. It's like,
Hmm.
oh, hey, yep, saw you like a month ago at the last
Yeah.
conference. Yeah, so it was awesome. Plus, awesome that you guys are getting the word of mouth. There's nothing more powerful than like word of mouth. Hey, talk to this customer because they're loving it, and then they actually come in and give you a super. That's phenomenal.
Yeah, yeah. So that was really cool to experience, and so we left really energized, off that conference, and yeah, just all things are pointing up into the right, which is great.
Love it. All right, well, Austin, we're kind of teasing around it. I'd love to kind of set the foundation for the conversation with two different things. Is like, first, I like hearing my guests' backgrounds because I think it helps bring a level of like understanding of what expertise and perspective you're bringing to the discussion. Because I I mean, you're over a decade in the energy industry, so I'll let you get into that, and then let's go from there into Synota. So let's start with your background and where are you coming from, and how did you get into this crazy world of Bitcoin mining of all things?
Yeah, so you're right. I've spent my career in the energy industry. The very first uh, half of my career was on the academic side. So I was, doing research as part of a PhD, and then a postdoctoral fellowship. And what I was really researching there was methane emissions, environmental impacts, economic impacts of energy development, and in particular the Marcellus Shale. And so after, going from measuring methane emissions, I went into oil and gas, where we were producing methane emissions,
Yep.
and got really, just my love for the energy industry just further deepened after that. And then I moved from Pittsburgh to Columbus and started working for an energy retail company based in Columbus. And the work there really was around financial risk, quantitative risk, forecasting, etc. So really doing a lot of the quantitative work for a retailer and getting to interact, with the trading and finance teams quite a bit. And then after that, I moved into the regulated public utility space, where for that utility, I led the strategy and risk department. So
Hmm.
again, a lot of things related to risk, and one of the interesting things that I tell people, kind of uh, leading to where Synota is focused on today, is here I am working for a utility that delivered an explosive gas to 3.5 million homes, but I was spending often most of my days focused on financial related risks,
Oh,
and
well,
so
naturally, right? I mean,
yeah.
that's
So not
yeah,
there was certainly talk of aging infrastructure and safety and things like that, but it really sort of through my career I really had my eyes open to what are some of the problems in the ways in which money moves in the energy industry.
yeah, and that does lead really nicely into Synota. So maybe let's go into like what problem are you guys solving for those industries?
Yeah, so the problem that to put it in a word, it's cash lag, and what that really means is look at your energy bill the next time you see it, and you'll see as we sit here today, December 1, you'll see that you're paying the next bill you get maybe mid December, you're going to be paying for energy that you consumed in October.
Oh,
And so that's fundamentally a very different calculation or sort of transaction than what we experience in our day-to-day lives. When I go to Starbucks and I buy a cup of coffee, I pay for it right then and there. So the product or service was delivered, I paid for the product or service. And so in the energy industry, what you have is, and it's really due to just sort of, the ways things always used to be done in terms of people reading meters. But you're in a situation today where across the board, you have this challenge between product and service in the form of energy being delivered, but then not being paid for 30, 60, 90 days later. And actually, across utilities, the average is 73 days separation between energy consumption and in payment for that energy. Now, what that
73 days.
ultimately means is, okay, so now you have
Yeah.
this misalignment of revenue and expenses at the distribution level. But if you remember that the people that distribute the energy to you or supply it to you, they're part of a long complex value chain within the industry, going all the way back to the point of production or generation.
Yep.
And so that means that then everybody else within that value chain is also experiencing that same cash lag. And to in certain scenarios, it actually compounds where the entity waiting to get paid then waits another 15 days to pay the entity that's upstream of them. And so you uncover scenarios where there may be oil and gas producers that aren't getting paid for up to 6 months sometimes
Yeah.
until after
Yeah.
they produce that molecule.
I was just doing the math in my head as after you said 73 days at the utility, I immediately was going up the stream. I'm like, holy shit, that's half a year, maybe a little bit longer before the actual raw energy producer gets paid out. So, okay, so I mean, obviously people know that like that's a problem. That
Mhm.
that's a challenge, it's a problem, but I would love for you to maybe crystallize that a little bit more as to like what specifically is that causing as far as like problems, even just starting at like the utility company. I mean, a 73-day lag on your cash flow, that's meaningful. So maybe touch on like what specifically are some of those problems? Like why is that a problem?
Yeah. So what I'll do is I'll make it maybe relatable to us as consumers of energy. When we're paying our
Perfect.
bill,
Yeah.
the very first thing is when you're operating on a bill that comes once a month and it's for energy that you used like, as we've said 1 or 2 months in the past. The very first thing is issues of non-payment, because you have these bills that come in that traditionally consumers haven't budgeted for, and so one of the very first things that jumps off the page is then the bad debt. So when you don't pay your energy bill, you get notifications of, well, here's your second warning, your third warning. But ultimately, in the United States, 5 to 7% of energy bills go unpaid,
Oh,
and so that's a big issue. And then you think about all of the inefficiencies that exist in sort of maintaining a process that is constantly trying to collect money, constantly threatening shut off. And so it's within sort of the you and me context that those costs and those inefficiencies start to stack up to where 10 to 20% of a typical residential energy bill, 10 to 20% of that has nothing to do with actually delivering the energy to your house. It's purely financial inefficiencies that are baked into the system. And so that's sort of the broad brushstrokes of how we all experience that today. And then it gets a little bit deeper though when you start to think about what is the non-payment challenge. What does that mean at a commercial and industrial level?
Yeah.
And so now we're talking about companies that consume large amounts of energy. So that same challenge of they're consuming the energy, not paying for it, that now means millions of dollars of liabilities at per company at the energy supplier side. So they're basically exposed to that credit risk of their consumers, and so that's really where additional inefficiencies get created when there is the requirements by those consumers of large amounts of energy to post collateral to basically cover that credit risk, to give their energy company an assurance that they will pay the bill. And so it's a very capital inefficient way to cover credit risk, is basically just to put part capital on the sideline and say, hey, I'm good for it because I've got X million dollars sitting here on the sideline.
Yeah. Wow. I mean, you just went through a handful of things that for me, it's like, it's just alarming. I mean, even the 5 to 7% unpaid bills. Yeah, I mean, that's super impactful. And then again, that ripples all the way up the stream too. So maybe before we get too deep, because I'm going to, again, this brought up a lot of stuff that I'm super interested in and curious about, but maybe just to back up a second, I don't think we touched on it. Synota, you guys are enabling these groups to have instantaneous settlement on payment. So maybe go there first before I keep bringing you down rabbit holes on how all this works.
Yeah, that's perfect. And so, so we've talked about the problem of energy being delivered versus paid for later, and what issues that creates within the industry. And so really the simple solution to that is to enable for the payment of energy to occur in real time with the consumption of energy. And so at Synota, what we are is we are a Bitcoin technology company. And so we are using Bitcoin as the medium of exchange for the automatic settlement of energy contracts, hosting agreements today. That's our main focus. Yeah. And by making it automated and providing really all of everything end to end, from that meter read all the way to the final cash application that an energy company would do from the money they receive in their bank account, doing all of that in an automated way, providing all of the accounting and information that's needed by energy companies and the consumers alike. Having that be so easy now makes it much simpler for companies to then think about, well, what if we don't do this on a 30-day cycle? What if we now do start settling our energy contracts on a daily basis, or our hosting agreements on a daily basis?
Yeah.
And so in doing that, what you're removing from the system is the credit. And you're doing it in an extremely efficient way. So you can think of, energy now becoming more similar to checking out at Starbucks versus the way it is today.
Sure. I hear that, and that's like, it's so revolutionary. I mean, it's just, which is silly when you think about it. I mean, instantaneous settlement. I mean, I'm instantaneously using the lights and the internet and everything that's going right now, but there's no way to instantly settle that payment. Are you finding anyone, like, are people having heartburn about that though? Because I would imagine it's very cool and needed, but then it's like, so I'm thinking from like a Bitcoin mining hosting perspective, it's like, well, shit, if Jim doesn't pay me for, his 5 miners this month, am I going to am I going to have a draw from the power company, even though I didn't get paid? So like, how does that work? Is that even a point of contention, or maybe you guys have that all figured out?
Yeah, so we work with energy suppliers, with hosting companies, and with Bitcoin miners. And the simple way to kind of think about how our platform works is there's going to be a contract between you and Jim, right?
Mm-hmm.
For hosting his 5 miners, there's some rate that's agreed upon and some payment terms that are agreed upon. The way that we work is we'll integrate with the source of truth, whether that is pulling information off the miner management software about energy consumption, or from a sub meter, or at larger scales, directly from the utility meter. So we'll pull in the information. We can pull in then the market data from ERCOT, PGM, et cetera. And then what we'll do is we'll digitize the contract between you and Jim. And so what that removes from the equation is you ever having to worry about creating an invoice, sending that invoice to Jim, then in turn paying that invoice, and then you
Mm-hmm.
making sure that Jim paid the right amount, and then doing all of your books at the end of the day. Our software takes care of all of that for you. So, the simple way to think about it is you don't have to worry about, invoicing and payments anymore, or accounting as a hosting company or as an energy supplier when you use our software for settlement. And
Okay.
so everything that we're doing is really about removing those pain points or sources of friction in the process, and helping the industry really stay focused on what it does best, which is, if you're an energy supplier, sourcing the best energy at the best prices and providing the best commercial opportunities for your customers. If you're a hosting company, you're really focused on protecting your margin and being the most efficient hosting company you can be. And if you're a Bitcoin miner, there's a whole host of risks you're trying to manage, and you're trying to continue to grow your operations. And so capital efficiency is a really big deal. And so if we can, provide a solution that, provides value to each of those parties, and does it in a way that's, extremely transparent, and it makes everyone's lives easier, that's really what our goal is.
Yeah, I love that. Would you mind if I go just a little bit deeper on, again, kind of the end consumer, which is the Bitcoin miner,
It's your show,
like
Ben. You can go wherever you
hosting
want to
client?
go.
Well, I appreciate that. It's just what comes to mind is like a scenario where I'll just use my own example. I'm on 8 cent power. I mean, there were points in time where I was severely underwater on the operation. Now, I weathered that with a ridiculous cash reserve because I knew I was going into a bear market and I had to survive. And I knew that my margin was going to go negative because of the power rate that I have for the hosting that I'm at. What maybe this is a mechanism of how the payment happens, but is that contract just saying, okay, this miner is going to earn X number of sats per day, and we're gonna take that for payment? Or maybe it's a strange question, I know, but I guess how do you handle the scenario where a hosting client may be going underwater on their payment, just given their cost of power and the price of Bitcoin and how much they're earning?
Yeah, so those situations occur, and what we have configured our software to do is to really handle those naturally. So first and foremost is you can use our software. You can pay in dollars, or you can pay in Bitcoin. And when you're paying in Bitcoin, you have really two primary methods of doing that. You can send Bitcoin to your Synota account, which is a node in the Lightning Network that you have the keys for. So you can either send Bitcoin there from your treasury, or you can what most of our customers are doing today is they are directing their pool payouts directly to their node. And so it's able to think of our software as really just sort of a stopping ground where payouts come from the pool, your bill gets paid, and then the profits then go to your cold storage, your vaults, etc. And so all of that would happen automatically. And like I said, you can also pay in dollars, where you can load dollars onto the system, and then it would just get drawn down as appropriate based on your actual expenses. Now, in a scenario where you are basically the cost of the power is exceeding your revenue in a day, our software will do one thing, which is it's never going to forget sort of what you owed. So if you put if you put one BTC of revenue, but your expenses were 1.25 BTC,
Mm-hmm.
that 0.25 BTC invoice will still stay outstanding. So it'll pay as much as it can, but you'll still have a remaining liability there. But for our customers, and as part of providing an all-encompassing risk management solution, we also can configure the software such that your hosting clients can have to maintain a certain reserve balance on their node to cover
Got
situations
it.
like that.
Yeah.
And so it's just a really unique way to approach it, where maybe your reserve balance is you need to keep 2 Bitcoin on your node at all times to cover to cover those types of scenarios. Your hosting company or your energy supplier will be viewing that in dollar terms. You'll be viewing that in BTC terms. It's still BTC in your custody, so you never had to convert it to post it as collateral, but it is effectively providing the same function that collateral would provide, which is assurance that invoices will get paid. So
Yeah.
it's sort of a fourth. We talk about it as a fourth way to really manage credit risk exposure. You have bonds, letters of credit, and cash, and now we're enabling you to do that in BTC held in your custody.
Okay. I really like it. I think it's almost a forcing function for responsible miner management, if you want to think about it that way too. It's
Mm-hmm.
like, this would be really attractive for a hosting company, knowing that the only way they're going to be able to onboard Jim is if Jim has, the appropriate amount sitting in a Lightning node to make sure that payment can happen. No, I think this is phenomenal. I hear it, and it's like, this is so needed. This is such a cool way to leverage the Lightning Network and instantaneous settlement. Are you hearing pushback? Is there, like, I guess I think it's such a perfect solution, but I would imagine some of the utilities may listen to some of this and say, what is that? Or like, what are you hearing when you bring it to utility companies and old industry like that?
Mm-hmm. Yeah, so I think there's a few things on that. So early on, in the conversation when we first engage, it's going to be a question of, do I have any exposure to Bitcoin? Is this something that's now going to be on my balance sheet?
Mm-hmm.
If the price, drops 10%, does this mean, now only, 90% of the invoice gets paid? So really some basic questions around Bitcoin being used as the medium of exchange.
Yeah.
And so really there our focus is, the answer is no. There's no exposure to Bitcoin. If you as a hosting company or an energy supplier are sending $100 invoice, you will get $100 directly to your bank, every single time. So it's, first just sort of kind of level setting on that, you're not going to have to really, change your accounting or do anything like that related to Bitcoin. There's no exposure to the underlying asset. Um, and so from there, really our process when we engage with hosting companies and energy suppliers, it's really around just getting stakeholders aligned, identifying who those stakeholders are in the company, because our software being an end-to-end from that meter read all the way to that final cash application, you can think about the different departments that ultimately are benefiting from this. But you could say we say benefit in terms of that's ultimately where we drive the alignment towards. But initially, it's just sort of like, hey, this is going to affect my job, and so it's really a process of aligning stakeholders from operations to treasury, to credit, to sales, et cetera, on how this is going to impact their functions, and then really communicating around how what will the future state look like with this software implemented. And that's really where my energy experience as well as that of my co-founders really comes into play, because we've been on the other side. We would, in
Yeah.
fact, all three of us would have been those stakeholders in those meetings if somebody else had developed this product. And so it's in that way that we've been able to really focus on how is it that what we're doing is really specifically designed for the customer, to not force them to really change anything about what they're doing today, keep the same accounting processes, keep the same treasury management processes, but just know that now you have cash in your bank, so that credit risk is gone. And so it's really just about reducing the friction that they experience today and helping, them ultimately do their jobs in a much more efficient way. So
Yeah.
I just would say it's really just a process of stakeholder alignment, which within, especially within legacy companies is a process. It doesn't happen overnight. And you have to make sure you're engaged with all the right stakeholders, from to get to that final endpoint of ultimately bringing somebody onto the platform. The one thing I'll highlight, which I think is an important aspect of what we're doing because it's relevant to where we operate. There are regulatory considerations that we have to work through as a company. So I wouldn't necessarily call those a friction point. I would just say that regulatory considerations can affect the overall value proposition that we're able to provide depending on where we're working. And it's not ever a blocker, but it is something that may force us to need to get creative in terms of how can our solution go that next level in helping mitigate risk.
Sorry to jump in there, Austin. What could you maybe just go a little deeper on that? Like what regulatory things might be hamstringing or maybe putting up a temporary roadblock? Like what are there some specifics that you can share?
Yeah. So there exactly one pops to mind, which is in the state of Ohio. So Ohio is a deregulated energy market, just like ERCOT is, or Texas is. And what's different in Ohio is that it's called a putback rule. And so what that means is that even if you are not paying your bills in Ohio, as a consumer of energy, you are not able to be dropped instantaneously by your energy supplier. There's a certain period of time that has to be afforded before the energy supplier can actually say you're no longer our customer because you didn't pay your bills. And so even if the customer stops making those daily payments on their invoices, the energy supplier is still under an obligation to serve that load. They cannot disconnect the meter. Now, that doesn't mean that there can't be ways to sort of work within the regulatory scheme, and that would be thinking about, well, what can you do behind the meter? Can you leverage miner management software to where a non-payment will ultimately turn those machines off? There's nothing that prevents that from actually being enforced through the contract, but it's an extra step. Whereas in states like Pennsylvania, the rule is 3 days, pretty small. So it's just sort of understanding the nuances between the states and how do you have to sort of work with what you're given. Yeah.
Texas is very business friendly like that. That doesn't surprise me that it's basically same day that they don't pay. At least they're like that when it comes to like rentals, like apartment rentals and things like that too. They're very pro business owner in the sense that you can have recourse very quickly. Whereas I'm in the great state of Minnesota. I think you could probably go a whole year kind of with the same type of rule, like a putback rule where, especially on like the natural gas side, we're predominantly heating our homes up here with natural gas. We get really cold. Like I think I'd have to check. I don't even know what the rule is, but I know that they can't just shut you off because people would freeze to death otherwise. I mean, it'd get pretty ruthless up here if people were getting their utilities cut off in the middle of winter.
Yeah, exactly.
Austin, you mentioned another thing I wanted you to go a little bit deeper on, and it has to do with like you guys being able to speak the language of these companies. And I think you put it in the sense of like stakeholder alignment at the utility to get them comfortable with this. Maybe go a little deeper on like how you guys are doing that. And I also maybe think it has to do with like telling them we can eliminate, I think you mentioned at the beginning, it was like 20% of a bill is due to like economic, I'm forgetting how you phrased it, but
financial inefficiencies. Yeah.
Yes. So, I guess the way to boil the question I'm asking you down is, how are you guys getting your foot in the door with these companies to begin with? Because a lot of them hear Bitcoin or Lightning Network and they just At least I find a lot of them check out or tune out. How do you guys even get a foot in the door?
Yeah, so I think the first thing is it starts with, where we all came from. Coming from energy, we came in building this business with a really strong network. So of course we're leveraging that network to get those initial conversations started. But what we're finding, and what we expected all along, has been, it's really the competitive advantage of our software. It's the sales side that's really becoming our initial first champions. And the reason being is because if you're an originator today at an energy supplier, you're able to offer terms that each of those stakeholders I mentioned before are comfortable with. So every supplier is going to have a credit risk policy, and they're going to have a process by which they evaluate their counterparties and decide what is the amount of risk that this counterparty presents, how much collateral do we need to require in order to do business with them. And so what is the case is that there are companies that kind of run the spectrum there, but if all things being the same, which in a very highly competitive, deregulated market, everybody's looking at the same data in terms of energy. And so there's not a ton of differentiation that's going to occur on, pure energy costs. There may be differentiation that occurs in terms of flexibility, different ancillary service programs they can get into. Mm-hmm. So there's some differentiation there, but by and large, what we hear is that it is in the credit and collateral type discussions where the rubber can meet the road in terms of deciding over one company versus another for energy supply. And so it's within that context that the people who are, maybe losing out on deals, the originators that are not having success signing up, large flexible loads to their portfolio, they're going to look at our software and say, well, here's a way that I can remove that credit risk from the equation, and thus, make an offer to a company or to a consumer where, we're significantly reducing those collateral terms to be more favorable ultimately to the consumer. And so that's really sort of the angle that things really sort of gain momentum, is through that view of, this is how I can be more competitive in the marketplace. And so where we sit today, it is the origination side of the business that really becomes the champion for Synota, and then leading those stakeholder conversations going forward.
Yeah, it's such an important thing that you're touching on too, and maybe help us, the audience, understand, like, how much collateral are we talking about? Let's just say it's a 5 megawatt facility. Like, what kind of collateral could they expect a power company to basically put their hand out and say, you're pretty risky, we don't really know about your business, and is it 1, 2, 3, 4, 5 months of an energy bill that they have to post for collateral? What does the collateral side look like?
Yeah, so there's really three. So it starts with just kind of like, what are the things that energy companies, and I'll sort of use the broad term energy companies to sort of say, what are the things that they're looking to sort of de-risk as part of any energy contract. Mm-hmm. So the very first thing would be if there's any investment made from a capital standpoint. So, dropping a new line, putting a transformer down, if there was capital investment made to service a customer, and then that customer is no longer there to then, ultimately pay for that capital, that's one thing that is sought to be recovered or protected. And then the next thing would then just be the physical energy itself. What is that charge you get, the accounts receivable risk, if you will. So that's another thing that an energy supplier, utility, et cetera, is going to be looking to mitigate through the commercial process. And then the third reason why companies are posting collateral today has to do if they're doing any sort of fixed price, hedging out energy into the future. Because of course there's the mark to market on that, but also that is now a future commitment to consume, to purchase energy. But if you haven't actually consumed it yet and paid for it, then that is another reason why an energy supplier utility would look to have collateral in the equation. So you have these three main areas, and so I mentioned those up front to say, depending on your specific situation as a minor or any large energy consumer, all three of those will drive ultimately the sort of collateral structure, commercial structure to mitigate risk.
Okay.
But now to kind of specifically focus on, let's just keep it simple and say, as a company, the only risk that I have is the accounts receivable risk. Well, we've been talking about this whole conversation of energy consumed but not paid for until a future date.
Yep.
What I think is probably the best rule of thumb to think about, because there are a lot of different approaches, is companies are going to, at least the ones that take, I think, the most rational kind of view of this, is they're going to say, well, what is my exposure to that credit? So maybe it's 50 days, maybe it's 60 days, and then the collateral terms will be set to really align with just that exposure. The energy supplier ultimately is going to try to find the lowest number possible without taking that risk on themselves.
Yeah. In this scenario, then we'd be looking at like 70 days worth of power that this group would have to post as collateral, because again, accounts receivable is the only risk. Let's just call it 70 days is, the cash lag on that accounts receivable. So, okay, therefore you need to come in and put up 70 days worth of collateral to shore up your, potential future, you walking away without saying goodbye.
That's right.
Yeah.
You may say
Okay.
you just don't pay the bill on the way out.
Yeah, that's right. Dine and dash. Yeah.
Yeah, that's right.
Okay. So maybe then on just this is kind of just checking, also just helps kind of talk through it. But let's go back to the first example you gave, which is like, all right, they had to do a substation upgrade. It was $100,000 upgrade. They can do the math and say, all right, you're going to eliminate 70 days worth of accounts receivable risk as well by using Synota. Do you have some insight into like how they're backing into like how much they could, because you're not going to get rid of the whole $100,000 collateral ask for the substation upgrade, but your software Synota is greatly going to help them reduce that.
Mm-hmm.
Do you have kind of like is there a ball? Maybe you can't even do a ballpark on it because it's so dependent, but in that scenario, do you know like about how much collateral are you going to eliminate from the equation?
On the substation piece or the the accounts receivable side?
The substation piece.
I don't have a good sense on that, because it is a little bit trickier. So what the range of things is, companies either just pay for that upfront themselves, um, or pay for part of it and then pay for the rest over the life of the contract. So it's one of those things that, again, it ultimately becomes part of the negotiation process. And so I can just say that, yeah, the range of things is, it's pay for it all up front, which is sort of, you've done, there is no risk because you paid for it, to I'm now going to spread those payments out over the term of a contract. And so in that way you can think more, I guess, traditionally in terms of how the collateral would incentivize that consumer to continue to operate that and pay the bill.
Sure. And it's not super uncommon for the utility company for the customer to come in and pay for the upgrades or pay for the infrastructure, that needs to come in, and then the utility company to basically pay that back to the customer over a period of time, and then the utility company then owns the infrastructure. I know that's not super uncommon. So, okay.
Yeah. I think the key message is that when you're doing contracting, like I said, a lot of other things are not differentiating variables, but when it comes to this side of the equation, this is still, put it all on the table. How are we going to ultimately sort through this to get both sides comfortable?
Yeah. I love it. Austin, just to keep a tab on the time, because we book ended was the phrase that we used to to describe your Friday, which it's usually Fridays are like you're taking a nap after lunch, but you're slammed. So I'm going to keep a tab on the time for us. I'd love to have you kind of walk us through like a 2, 5, 10-year look at what is Synota going to be doing? What kind of cool stuff can we expect to see? I'd love for you to kind of lay out a roadmap for what we can expect to come from Synota.
Yeah. So I think the first thing is, we've been really sort of in this conversation and intentionally so focused on, hey, what is that immediate problem we're solving? What's the solution we bring to the table? But I think, your question gives me an opportunity to kind of paint a high level view of really what does our software do,
Yeah.
and then think about kind of where that can then apply, going forward. So we often talk, energy, and the energy industry really has three primary value streams. There is the energy itself, the molecules and electrons. Then there's the data. So, in that can take on many forms, but it really matters when you're using energy, how much you're using, where did it come from, data of all sorts. And then the final thing is then the money, or the cash. So these are the three primary value streams. And today, all of those are very disconnected. We've talked today about the money side, but then I would
Yep.
just layer in then the data piece is also very disconnected, to where data is extremely siloed. Rarely do customers have access to their own information. It's very difficult for third parties to get access to offer additional products and services. Our platform integrates all three of those value streams together. So now you have the data and the money moving in real time or synchronously with the energy. Now, that opens up a world of possibility in terms of where we will go long term, because it's really solving a problem that has been known for greater than 20 years. It's actually the Department of Energy that has been very focused on this particular topic, because they recognize that the energy transition, the movement to a more decentralized energy system is underway, a smarter
Yeah.
grid is underway, but
Yeah.
none of that stuff will really reach its full potential if you don't have the right economic incentives baked into the system. And so what the Department of Energy, talks about is that you have value needing to be the key operational parameter within the energy system. And so that's really where our software is going. We are driving the Department of Energy's vision forward. Now, to make it a little bit more tangible, the 5-year timeline,
Mm-hmm.
let's think about, within what we're doing today. We're really leaning heavily on providing this competitive advantage in deregulated markets, growing within the Bitcoin mining, within the data center space. And so you're going to see, us as a company continue to expand within this area. But one of the things that, is sort of an immediate adjacency, once we talk about these large loads that are high credit risk, the next adjacency is really think about where are data centers and Bitcoin miners, who's next to them in a physical
Yep.
sense. It's renewable energy. And you think about the way that Bitcoin miners and data centers are interacting with markets. It's lots of, heavily, playing within the ancillary markets and doing demand response programs. I mean, they are really the energy consumer of the future. And so what's embedded in that is that this is a much more dynamic, much more real time approach to energy in a physical sense. And so being a solution that can then synchronize with the money in the data, now we are expanding into really that whole large flexible load segment into that intermittent generation segment, which is a much more complicated system than what everything was built on today.
Yes.
Today
Yep.
we live in a world where payments only go from consumer to utility, then utility to supplier, et cetera. It just, everything is daisy chain. It's very one directional. We're talking about a world where money, you can perform a grid service and you as the consumer are owed money. So it's all of
Yep.
that flexibility. It's the bi-directional payments. It's really leaning into that space next, as the growth. And then as we kind of move further downstream, it's looking at multi-party payments. And so we have actually customers today set up to where we're already moving further up the value chain, where it's not just a Bitcoin miner paying a hosting company and then the deal's done. In this situation, not only is the hosting company and the miner on our platform, but so is the energy supplier. And so now you have a multi-party settlement happening in that same real-time sense, which is just another layer of efficiency being gained. And then from there, I think then it starts to really expand into, well, what are the other key elements of the energy economy that these sectors really interact with? And we think about derivatives and margining. So that is actually a source of high friction as well. Another area where a lot of collateral is being cash is being tied up in collateral because of that future liability that those represent. So you can think about margining, you can think about investing. So the example that we always give is internationally in emerging markets, why is there a lack of private investment in emerging markets into energy infrastructure? And one of the key blockers to that is the risk and cost of actually bringing funds back to, repatriating those funds. If I'm in America, I'm investing in sub-Saharan Africa, it's going to be really challenging for me to earn to get the return on my investment because of the friction that exists of actually bringing the money back over, to pay me for that investment. With a platform like Synota, all that friction goes away. And so now you can be earning your return on a daily basis through the Lightning Network right to your bank in the US. And so the last thing I'll say is then, this one really kind of pulls on the data side. Think about from a climate perspective and, what we are doing today in terms of carbon markets and renewable energy credits. It's a very convoluted, very inefficient system where, right from the get-go, you're separating the energy from its environmental attributes, and they just follow two separate pathways.
Yeah.
Our software, because it's, ultimately you're getting a receipt for the energy that you've consumed,
you can
the environmental attributes,
the source. Yeah.
They're on the receipt. So now you've kept that all connected from start to finish. And so it allows you now to envision, well, what is a better construct for how we think about environmental attribution and how we ultimately, internalize externalities into energy markets.
Thank you, Austin. I was a little clumsy on how to respond to that because all of that is just really, really, really needed. I love the foresight that you guys are having with how you're kind of approaching different segments of the market with the technology. So that was phenomenal. Super exciting. What's the most exciting for me, one of the big draws to Bitcoin mining for me is the enmeshment with physical infrastructure, demand response programs, and coming in and making energy projects more economical. Now there's you guys that I get to watch and be really excited about because you're also helping Bitcoin enmesh itself into the payment system behind this physical infrastructure. So it's insanely awesome to hear. I look forward to seeing the 2, 5, 10 years from now. That's going to be awesome to watch. As we kind of wrap up here, Austin, I'd love for you to give a handoff. I want the audience to be able to get in touch with you. How can they get in touch with you? Synota at large, maybe just share all of that.
Yeah. So the first thing I would do is I would, I'll point you to our website, synota.io. And I point you there with a giant disclaimer of we haven't updated that website really from the get-go.
Sure.
But the button that says contact us, it does work. So feel free to use that and, we'll get that email. And then I would say that I respond to DMs on Twitter. So I'm at
good for you.
AIS. Yeah. I don't get that many, so it's not like I'm struggling to keep up. But maybe given being here, I'll all of a sudden start to see a flood, which would be welcome. I spend enough time on Twitter already that responding to some DMs, in between is quite all right.
Sure.
It's better than just scrolling through. I'll do something a little more productive.
Yes.
But yeah, so I'm at AACS Mitchell with 2 L's. And so yeah, feel free to follow me there and shoot over a DM. Happy to get in touch with folks who are interested in what we're doing, or would want to join us and work for us, or whatever else in between. But yeah, it's great having the conversation with you today. And I think one thing I'll say is, you shared kind of the excitement for how sort of, this is growth within the Bitcoin, ecosystem, Bitcoin as a medium of exchange and what this can mean, for everything that I think everybody in this space is working towards, a future that we're all working towards. But I'll acknowledge Bitcoin mining as really the key that brought us into the space because of the innovation that we saw. It really was seeing Bitcoin miners and how they approached energy. It was everything that they had been talking about, or, everything academic literature was talking about, flexible loads, demand response, real-time pricing. Bitcoin miners just came in and started doing it. And as somebody who has been in energy my whole career, when you see innovation happening at that pace and people who are just showing up and doing the work, like that's what I love about this space and what brought me into it. So just, I guess, an acknowledgement back that, we're really excited about what we're doing, but it was the excitement around Bitcoin mining that, led us here.
Yeah. It's a mutual shared love. It's tangible. It's real. The innovation is breakneck. I mean, my God, is it all happening so fast? So Austin, this was phenomenal. Thank you so much for the time today. I'm glad that people now can reach out. I hope that we flood your DMs.
I'll let you know when
Twitter.
I'm getting overwhelmed, and we'll have to maybe cut that segment. No.
Awesome. Well, Austin, you have a good rest of the day, good weekend, and you take care.
Likewise. Thank you so much for the time. Great chatting.
Awesome.